So, what do the LSATs or the quantitative easing, what do they do? We anticipated quantitative easing. What does it do? We anticipated when we took these actions that we would be able to lower interest rates, and that was generally successful. For example, 30-year mortgage rates have fallen below 4%, which is historically low level, but other interest rates have fallen as well. The interest rates corporations have to pay on bonds, for example, have fallen, both because the underlying safe rates have fallen, but also because the spreads between corporate bond rates and treasury rates have fallen as well, reflecting greater confidence in the financial markets about the economy. And lower long term rates, in my view, and in the Fed's analysis, have promoted growth and recovery. Nevertheless, the effect on housing has been weaker than we hoped. We have gotten mortgage rates down very low. We would think that would nonetheless, the effect on housing has been weaker than we hoped. We have gotten mortgage rates down very low. We would think that would stimulate housing, but the housing market has not yet recovered. The Fed has a dual mandate. We always have two objectives. One of them is maximum employment, which we interpret to mean trying to keep the economy growing and using its full capacity, and low interest rates are a way of stimulating growth and trying to get people back to work. The second part of our mandate is price stability, low inflation. We have been quite successful in keeping inflation low. It has been a help that Borker in particular and also Greenspan made it much easier for me because they had already persuaded markets that the Fed was committed to low inflation, and the Fed has built up a lot of credibility over the past 30 years or so. As a result, markets have been confident that the Fed will keep inflation low. Inflation expectations have stayed low, and except for some swings up and down related to low oil prices, overall, inflation has been quite low and stable. At the same time, while we have kept inflation low, we have also made sure that inflation has not gone negative, particularly around the time of QE2 in November 2010. There was concern that inflation had been falling. It was well below normal levels. The concern was we might get into negative inflation or deflation. Deflation has been a big problem for Japan's economy now for quite a few years, and I talked about deflation also in the context of the Great Depression. We certainly wanted to avoid deflation, so monetary ease also guarded against the risk of deflation by making sure that the economy did not get too weak. One more comment on large scale asset purchases. A lot of people do not distinguish between monetary and fiscal policy. Fiscal policy is the spending and taxation tools of the federal government. Monetary policy has to do with the Fed's management of interest rates. These are very different tools, and in particular, when the Fed buys assets as part of an LSEP or QE program, this is not a form of government spending. It does not show up as government spending because we are not actually spending money. What we are doing is buying assets, which at some point will be sold back to the market, and so the value of those purchases will be earned back. In fact, because the Fed gets interest on the securities we hold, we actually make a very nice profit on these assets. We have What we have done over the past 3 years is transfer about $200 billion in profits to the Treasury. Then money goes directly to reducing the deficit. So these actions are not deficit increasing, they are in fact significantly deficit reducing. So a major tool we used when we ran out of room to lower short-term interest rate was LSAT, asset purchases. So a major tool we used when we ran out of room to lower short-term interest rate was LSAT. When the Fed ran out of room to lower short-term interest rate, when the Fed ran out of room to lower short-term interest rate, when the Fed ran out of room, ran out of, ran out of, ran out of room to lower short-term interest rate, ran out of room to short-term interest rate, ran out of room to lower short-term interest rate was asset purchases. To the other tool we have used to some extent is communication about monetary policy. The other tool the Fed have used the other tool the Fed have been using to some extent is communication about monetary policy. To the extent that we can clearly communicate what we are trying to achieve, investors can better understand our objectives and our plans, and that can make monetary policy more effective. Investors can better understand our objectives and our plans, and that can make monetary policy more effective. To the extent that the Fed can clearly communicate what the Fed is trying to achieve, investors can better understand the Fed's objective and the Fed's plans, and that can make monetary policy more effective. The Fed has taken a lot of steps to become more transparent about monetary policy to try to make sure people understand what the Fed is trying to accomplish. For example, 4 times a year since 2011 April, after 2-day FOMC meetings, Ben Bernanke gave a press conference and answered questions about monetary policy decisions. This is a new thing for the Fed in terms of trying to explain what our policies are. More recent step that we took in communicating our policies more clearly was to put out a statement that described our basic approach to monetary policy, and in particular, for the first time, gave a numerical definition of price stability. Many central banks around the world already have a numerical definition of price stability, and in our statement, we said that our purpose, for our purposes, we were going to define price stability as 2% inflation. And so the markets will know that over the medium term, the Fed will try to hit 2% inflation, even as it also tries to hit its objective for growth and employment. Finally, the Fed has also begun to provide guidance to investors and the public about what we expect to do when the federal funds rate in the future, given how we currently see the economy. So, given how we currently see the economy, we tell the market something about where we think that the rates are going to go. to the extent that the market better understands our plans, that is going to help reduce uncertainty in financial markets. And to the extent that our plans are, in some sense, more aggressive than the market anticipated, we will also tend to ease policy conditions. 5. Making the market ready for aggressive policy.